Really rough day yesterday with big names such, of course, Facebook leaving away down 25%. But it wasn't just Facebook, right? I mean, there were a lot of other names that were blamed for bringing the NASDAQ down. Joining me now, Michael Lee and Rob Luna. Guys, you know, Facebook, Amazon, Microsoft, Apple, and NVIDIA, those names were half the losses in the NASDAQ yesterday. So to me, it underscores something we've talked about, how these indices are just kind of skewed, if you will. But it also, I think, is why this is a stock picker's market. Do you think that that's still the case, Rob?
Oh, yeah. I mean, absolutely, Charles. I mean, we talked about it last week. If you're going into technology, you got to be able to be in some of those names that are going to be resilient. We talked about Palo Alto Networks and ServiceNow. Why? You always need cybersecurity out there. ServiceNow, actually, as the economy slows down, those are the names that people put into their company to displace people, unfortunately. But then you look at the other side, like Facebook, and yes, I personally was a victim of that atrocity yesterday also. If they miss at all, it's been an absolute woodshed moment for those stocks. So you have to be very selective in the stocks you're putting in your portfolio right now.
Now, even before this week, a lot of names had already been taken to the woodshed. Today, a lot of them getting a reprieve. Big monster moves on Snap. Amazon, which has really been a laggard, Pinterest, Unity Software, and it's still like a million miles below their record highs. So is that a place, Mike, where you start to look? Are you starting to sift through some of those names now?
Yeah, Charles, I was here last week and I thought Facebook was one of those names. Unfortunately, Apple has just collapsed the business model of Facebook, and they were unable to transition. So even though it's up big today, Snap is where you want to look at. A lot of these ad spend dollars that were going to Facebook, the single greatest advertising platform ever created, is now in a state of flux. I don't know that the move down yesterday was enough. It is a big hill for them to climb, but Snapchat is definitely your prime beneficiary of this. And then Amazon. I mean, look, this company is resilient, and not only are they with the consumer, raising the money, raising the price of Prime, but the cloud computing. So Amazon's got a very diversified business model. They're not going anywhere. Again, down big from their high. But I think the safest play in the whole tech industry is Microsoft.
Yeah, you know, Rob, to that point, it's rare you can see a stock up 59% and it still can be considered cheap. I mean, is this a dead cat bounce, or do you start to climb on the train here?
Yeah, I mean, look, Snapchat, I'm not in, Charles. I mean, I completely agree with Amazon. Amazon's been really resilient. And one thing, just a little deal that I've been noticing this year, Amazon was a significant underperformer last year. So right now, their news wasn't that great. They actually guided down a little bit if you look at FX, and that stock's doing well. I think that one's playing catch up a little bit. So you have to look at that Snap on a day where it's up 60%. You know, from my experience, I wouldn't be a buyer today. Give it a couple days. I like what's going on there, but, you know, be careful jumping in here.
The flip side of this, of course, is going back to last year when the 10-year yield spiked, everyone said, you got to be in value. And, of course, the implication is growth names are expensive. Value is, quote, unquote, cheap. So I want you to take a look at today's, one of the biggest decliners of today, Clorox. Now, you know, its gross margins plunged, by the way, 33% from 45%. But here's the thing, and what I want to share and teach the audience. This stock was trading at an all-time high with the PE ratio. And so I think there's a lesson to be learned here, Rob, about what is real value, right? I mean, because something is in a sector that's known to necessarily that trades less at a lower PE, within that sector itself, it can be overvalued and therefore a higher risk, can it?
Yeah, no, and that's the thing, Charles, for new investors. A couple of things. Value doesn't mean value, and low price doesn't mean a cheap stock. You have to understand that. And because people have been hiding out in these names, it's pushed the valuations up. And so when you look at Clorox, it seems counterintuitive, but that's more expensive than Facebook, which is actually trading at 18 times right now, lower than the S&P 500. And obviously, they have some challenges, but they're going to grow a lot faster than Clorox over the next 2 to 3 years.
All right, so let's talk about what you guys like, all right? I brought up the things that I was intrigued by. Mike, you know, I don't know, my man. You're a little bit low energy today. You're not this ain't the Mike Lee. Did you get scuffed up a little bit this week? Because you're feeling a little low energy to me.
So, sorry, Charles. The name out there that I like. Yeah, a little rough at jiu-jitsu this morning. Got worked up. So anyway, Apollo, a private equity company. The stock is on an absolute tear. It still trades with an 8 PE, over 3% dividend. If you think about it, it makes sense, not only from a technical standpoint, but asset values are at or near all-time highs, and so that 2 and 20 being charged on that. A lot of exits coming out of these, a lot of SPAC buyers out of there want to buy portfolio companies, different ways for these companies to make money. It's a cheap company. It is well run. A lot of headline news after Leon Black was forced out.
Right.
The stock is on an absolute comeback. I'd say it kind of falls into all the themes we're looking at today.
Rob?
Yeah, I mean, I think